Ladies and gentlemen, my fellow Tesla stock investors, we need to talk about our markets and Tesla before things potentially get worse. You're in a precarious situation given the data that we had today with CPI really was just bad news across the board. Now we have some data coming out tomorrow morning, which is the PPI. We also hear from about 3 different Fed speakers that are scheduled. There could be other statements that are unscheduled that I don't know about, but right now you have 3 Fed speakers tomorrow. And the Fed speakers, they're going to hold a lot more weight now that you do have a hotter than expected CPI report for the 3rd month in a row. And as I shared with you in the last video, this report was hotter across the board than any major bank's forecast. So it was a real disaster today. But not just because it came in hotter, but you're actually starting to see super core rising. Again, it's been rising for many months now in a row at a slow and steady pace, but you're also seeing goods inflation, which is really starting to ramp up, and this could be wildly problematic. Mix a strong consumer with rising wages and rising commodity prices, and that's a recipe for goods inflation to surge again. So we need to talk, ladies and gentlemen, before things get worse. And yes, I am expecting things to get worse, broadly speaking, here in the next coming weeks, and I'll explain why that is. Now, things are not all doom and gloom for Tesla. Let's bear in mind, Tesla is the worst performer in the S&P year to date. You've priced in a lot of bad news for Tesla, not so much for the broader markets. What kind of effect does a broader market correction have on Tesla? I think that's the bigger question. So with that said, hit the like button, subscribe to the channel, let me know what you think about this information down below in the comment section. Let's get into it. So there's a couple things we need to do here in this video. As you already know, inflation came in hot. The odds inflation continues to go higher are becoming more obvious. Typically, economists like to think of trends in on a 3-month basis. If you see a 3-month decline in something, that usually means it's on a trend downwards. If you see 3 months higher, it usually means the trend is higher. So it seems like inflation, at least for now, is going higher, and that means likely it's going to continue to go higher. And one of the reasons why you did see the NASDAQ, S&P, as well as the Russell get absolutely obliterated today, especially the Russell, is because now the markets are pricing in the first Fed rate cut in September. Not too long ago, like last week, you were pricing in the first rate cut in June, and then it went to July, and now it's in September. Now, let's be honest. We started off 2024 with the expectation we were going to get 7 rate cuts. Now, the areas of the markets that don't need rate cuts have outperformed. Coincidentally, those areas are also the areas that control the S&P and the NASDAQ, broadly speaking, like your big tech names. Big tech earnings are not dependent on what the Fed does, whereas other companies like Tesla and small and mid-cap stocks have definitely sold off a lot in 2024. If you're a Tesla investor, you understand that firsthand because of these rate cuts getting pushed out. So I think you got to think about the markets in 2 different ways. This hotter than expected inflation report, kicking the can down the road for the Fed to cut rates, is really negative for interest rate sensitive names, at least in the short term. It's really negative for a stock like Tesla. With that said, companies that are grouped into small mid-cap names, interest rate sensitive companies, well, if they can grow EPS, then they're not going to do as bad. That brings up the question for Tesla. Does Tesla focus more on profitability? I think so. On Tesla's earnings on April 23rd, we're probably going to hear that from Tesla executives. And Tesla stock can do just fine in that market environment, even though you're seeing this very negative headwind from rate cuts getting pushed out. It doesn't necessarily mean Tesla needs to continue to do terrible if the markets start to project higher EPS throughout 2024, as I am expecting. But definitely from now until April 23rd, minus any price increases or anything that's accretive to margins or EPS, you are going to have a negative tone for the markets. I think what people are trying to figure out is inflation going to just trend upwards? Is it going to rapidly rise in the upward direction? And as I showed you, really the good side of inflation, you really haven't seen any goods inflation since, mid 2023. Goods inflation has basically been gone. But when you think about goods inflation relative to services are highly dependent on labor, right? People cut your grass, cut your hair, right? Concerts, whatever it is, services, okay? It's very labor dependent. So that's why you tend to see service inflation running well above 2% on any normal, year, whereas goods inflation tends to be a lot less than that, okay? Now, goods, think about manufacturing, think about, an iPhone or vitamins, whatever it is. It tends to be a lot less about, humans, right? Wages. It's more about commodities. It's more about, oil and other things like that. Okay. So goods, I guess you can mix in there wages as well, because there is some kind of, human power behind creating things. But if you're creating vitamins at scale, your biggest cost is not likely, humans or wages. It's likely your commodities. Now, people have this false narrative that oil only affects oil, and it literally only affects oil. That's not correct. Anything I can show you, Tylenol, Motrin, AirPods, Twisted Teas, again, vitamins, anything that I can look at right now, TV on the wall, it all got here transported via oil. So if oil continues to rise, commodity prices continue to rise, and you throw on their wages rising, you're set up in a less favorable way for goods inflation. And if goods inflation does start to accelerate, as it kind of looks like you did in March, that's going to be very problematic for CPI. And that's what makes tomorrow so important. Tomorrow morning, we get PPI and core PPI that comes out. CPI, if you don't know, stands for Consumer Price Index. PPI stands for Producer Price Index. So usually producer prices rising, well, companies pass those costs on to consumers so their margins don't degrade and erode. And that's kind of how things tend to work. Now, PPI is heavily correlated to input cost, like wages, commodities, so on and so forth. And you've definitely seen commodities go higher. Look at cocoa, look at gold, look at silver, even though they're less commodities as, I guess, commodities, currencies, whatever. And oil, right? That's a big one. They've went up recently. PPI is probably going to come in hotter than expected as well, considering the CPI report we got today. But PPI can be a good indicator of the good side of inflation. Okay. Because of those input costs and the way companies can pass those costs on to consumers. Now, PPI tomorrow, the headline is expected month over month to be 0.3%. Last month was 0.6%. So you are expecting a big slowdown in PPI. If we don't get that big slowdown, expectations are going to move higher for CPI next month, for the month of April. Now, core PPI is expected to come in month over month at 0.2%. Last month was 0.3%. So if you get a hotter than expected PPI report tomorrow, that's going to solidify we're probably in for higher CPI reports over the next coming months. And right now, nobody's talking about raising rates. But if inflation continues to come in hot, give it a month or two and the conversation will become not is the Fed going to cut in 2024, but is the Fed going to raise rates in 2024? And that's where you could see just broader weakness everywhere. Your big tech, obviously interest rate sensitive names as well. Now, the markets responded to this also, and this is something we want to be watching pretty closely here. The US sees missile strike on Israel by Iran and proxies as imminent. Iran proxies may strike Israeli military and government sites. It says Iran and proxies. Attack would mark major widening of conflict in the Middle East. Now, why do you want to watch this? It's simple, and I'm being redundant here. I understand, but I think everyone needs to hear this. This is the flow of oil tankers, and here you can see the dates just going by. June, that was May. Now you're in June. Thousands of oil tankers every single day, and 30+% of the world's oil supply flows through the Strait of Hormuz every day. Well, here's Iran. If there's a conflict in this region, odds are oil is going higher. Okay. And that, from an input cost perspective, is very important. Whether your product is directly, involved in, oil itself, like a plastic, right? That's obviously bad for like those kind of products, but everything gets transported. And if oil goes higher, that means prices are likely to go higher as well, especially on goods and as well on services. Would be another, I guess, kick in the back for the markets if you did see a larger conflict in the Middle East that did cause the price of oil to continue to rise. Take a look at this main headline on CNBC. It says the super core inflation measure shows the Fed may have a real problem on its hands. Markets are buzzing about an even more specific price gauge contained within the data, the so-called super core inflation rating. The gauge measures services inflation, excluding food, energy, and housing, and has been roaring higher lately, up 4.8% year over year in March, and more than 8% at a 3-month annualized pace. Yeah, that's a problem. The picture is more complicated because some of the most stubborn components of services inflation are household necessities like car and housing insurance, as well as property taxes. So this super core inflation measure that continues to go higher, that's a problem in and of itself. But if goods starts to rise also, as it looks like you're seeing over the last 3 months, that's an absolute shit show waiting to happen for equities. Now, we only had one speaker today, and that was Fed Goolsbee that spoke, and the markets really didn't pay attention. There wasn't too many headlines that came out. Now, tomorrow, you're going to get a lot more Fed speakers. Fed Williams will speak at 8:45 in the morning tomorrow, Eastern Standard Time. Fed Collins will speak at noon, and Fed Bostic will speak at 1:30 p.m. Whatever these 3 Fed speakers say tomorrow, the markets are going to pay very close attention as kind of forward-looking Fed policy following this latest CPI number. If any of them start to talk about potentially needing to raise rates again, that's where things get very problematic. Now, I don't know if that's going to happen. We can only speculate to whether or not that's going to happen, or if we would need to see a couple more inflation reports, come in really hot. But you're getting closer to that moment. And it's actually remarkable how well stocks are holding up, given all of this bad news. Bad inflation news recently, and just bad news overall in, the Middle East and other, areas. You're still holding up your huge gain you've seen over the last 3 months, and really in 2024 for the broader S&P and the NASDAQ. Now, clearly, if you look at the percent of stocks above their 50-day moving average, it's not that good out there, right? You had 12% of stocks today, 12%. This is the biggest number I've ever seen in a single day. 12% of stocks, 12.26% of stocks break under their 50-day moving average today. That's insane. You only have 45.68% of stocks above their 50-day moving average. This is down 21.16% today. That's wild. Considering this, stocks still close to all-time highs is remarkable. Now, if you are a technician, if you like technicals, if you think they tell you things, well, I think the Nasdaq's technicals are screaming at you right now. You found support today at the 50-day moving average. 50-day moving average is at $436.56 per share, so about $1.50 higher than where the NASDAQ currently is. You found support here three trading days now of the last 5, and maybe you could say this day as well was pretty close, but you've bounced right at this level 3 of the last 5 trading days, and you were pretty close here yesterday as well. You are now in a downtrend for the NASDAQ. It has been very, very slow, very, very slow, but you are definitely starting to form this downtrend. When you want to be a little bit more concerned about a larger correction, or maybe hedging a little bit more, is if we break under this 50-day moving average. If you break under that 50-day moving average, you're going to trigger a boatload of algorithms to start selling stock. And then you set yourself up for what could be downside to that 100-day moving average, which would be about 4% lower on the NASDAQ. Honestly, I see that as a base case at this point. I think the NASDAQ should probably already be at that 100-day moving average. I think it's just a matter of time before that happens. And who knows exactly what that is. That could be the Iran-Israel situation. That could be, next month's CPI. That could be, the economy at this point. Who knows? But that's another thing to consider as well. The markets have held up so well, not because the Fed's going to be cutting rates or anything like that. The markets have been holding up so well because earnings estimates have been going higher, and they have remained, good. Now we're starting earnings season this week and next week. Tomorrow morning, you have CarMax, Constellation Brands, a bunch of other smaller names as well. But your big banks will report on Friday. You have JP Morgan, Wells Fargo, BlackRock, Citi, Progressive, and State Street. They're going to give you a lot more insight on the state of the consumer. The consumer, if they were to slow down at this point, spending money, that would obviously be problematic for company earnings. And that's why stocks have held up so well, because people are like, hey, consumers have jobs, they're spending money, earnings are going to be good. If indeed this earnings season shows that maybe that's not the case, then you're looking at like a crash, right? Because expectations are up here for consumer spending money and earnings. If we are way over exaggerating what 2024's earnings are going to look like, that's a big problem. Now, I don't know if that's happening, but you could see how expectations are very high. This whole rally at this point is based on not the Fed, but earnings coming in good. So I think that is your real big catalyst to be watching for. But inflation, it's not like inflation continues to come down and the Fed's going to start cutting rates. That's not the backdrop that gives the markets a little bit of emotional support. There is no emotional support in the Fed cutting rates because it looks like they're not even going to in 2024. And that's why I think the markets are in a little bit more of a dangerous position as of right now. But I do think to a large extent, this is going to be on a company by company basis. Okay. Now, Tesla today stayed right at about your 20-day moving average. That's a very important level to change or start a trend. And Tesla has been going higher ever since you did hit this recent low, April 5th. Things have been pretty good today. Not so great. The stock is down about 3.3%, including the move in after hours. And you are, I believe, going to battle around this 20-day moving average for a period of time. Now, I think Tesla specifically, it's going to come down to earnings on April 23rd. If earnings come in, bad or good, I don't think that really matters. But if Tesla is going to focus more on profitability, I think that means Tesla can do well, even if the markets don't. Now, during a crash or fear event, a fear moment, of course, Tesla could fall a little bit. But I really think it's specifically company by company in that regard. If Tesla is going to be more profitable, Tesla stock is likely to do well. So I don't necessarily think Tesla is doomed at this point. Obviously, if Tesla cuts prices or we get any other bad news, that's going to be problematic, and I would expect Tesla could even fall under 160 in the event we get bad earnings, bad news maybe from Tesla, and the markets sell off because inflation's rising and the Fed's not going to be cutting rates and maybe earnings underwhelm broadly. yeah, that could be a very problematic situation for the broader markets. And I think a lot of investors right now hardly have a correction on their radar, let alone a full-on crash right now. And it's possible. The way things are going, it's definitely possible the next couple of months could lead to a larger downturn. Also worth mentioning is the 10-year treasury yield was up 18 basis points today, really because inflation coming in hotter than expected, the government spending like they are drunk. Those are really the two reasons that treasuries just continue to rise, and you're now above 4.5%. 4.5% is seen as a very critical level for investors. It's seen as really a breaking point for stocks. Now, you broke a little bit. The markets did decline a little bit today, but not nearly as much as what we could see ahead. Especially if 10-year treasury yields continue higher and get closer to 5%, then you're really going to see some downside for stocks. Now, I just want to say this as clearly as possible. Markets are priced for perfection. We're not getting perfection. Quite the opposite in 2024. Things are going bad. If earnings are also not beyond perfect, you're going to see a lot of downside in the broader markets. But the areas of the markets that have already fallen a lot, like Tesla and small caps and interest rate sensitive names, they are way better priced for that event. And odds are it could be the upper tiers of the markets that do sell off. Obviously, it's going to depend again company by company, but I am expecting a larger correction from here. And again, I think this does happen over the next coming months. But if Tesla does have good earnings and forecast higher profitability or better profitability in 2024, considering how negative people are in Tesla right now, I still think Tesla could do well, even if you do see a correction in the markets. Because, it's the worst performer in the S&P. If we get good news from Tesla, nobody's expecting that, and Tesla stock could rocket higher. Even consider this. If people are shorting Tesla to hedge the markets, which so far has worked pretty well, and you get good news from Tesla, maybe Tesla stock goes higher, that could lead to shorts potentially covering on short positions. If Tesla inverses the markets at some point, that's problematic. And you're at the highest level of shorts you have seen in a long time. So statistically, on paper, the numbers here, Tesla's vulnerable for a big upside move. If we do get good news, you have 3.88% short interest of free float with $19.02 billion currently sold short and about 107.5 million shares that are currently sold short. Now, in the event earnings come in line with expectations, you likely do see the S&P still draw back to maybe 410, and I'm looking at the triple Qs here, down about 6% from these levels. If earnings come in not so great, then you're likely to draw down another 10% from here. That would put you down to your 200-day moving average. That would basically erase all of 2024's gain. And let's be honest, 2024, you haven't gotten great news. There's not a great reason to be bullish on stocks unless you believe S&P 500 EPS is going to grow over 11% this year. That's the current expectation. And it really comes down to big tech. Excluding big tech, EPS is actually expected to fall 2% this year. So if big tech comes through and saves the day again, well, then the markets may do okay. And Tesla, in the event that Tesla is not going to focus more on profitability, that they would be willing to cut prices again, I'm still targeting that 147 level. If the markets were to get really bad and earnings underwhelm broadly, then you're looking at the 130s. But I want people to be pretty careful, even if we do start to go into a larger downturn in the markets, with their downside projections. Because, 130, just to hit 130 from here, would be another 24% decline. Could that happen? Of course. Tesla is already priced for really bad. I do think the next couple of weeks are going to be very important for stocks. This whole Middle East situation mixed in with the continued data that we are going to get, including tomorrow's PPI report and what the Fed is saying about this. I mean, the Fed, they start talking about potentially raising rates, that's a problem. Right now, we're expecting the first cut in September. I think that's probably where we're going to stay until we get some more data. And just that in and of itself should probably cause stocks to fall. If bank earnings underwhelm on Friday, that's a bad sign for the rest of earnings. You could see even larger downside based on that for indexes. I think bottom line, it's really only a matter of time. And Tesla can do well if Tesla gives us, higher margin projections, better EPS throughout 2024. If that's what Tesla forecasts to us, I would expect Tesla to do well. I don't know if that's going to happen. Expecting that, I think, is not the best way to go. I'm hopefully optimistic that Tesla is going to focus more on profitability. In that case, Tesla could rally as the markets fall, and that would be a big change compared to what we have seen recently. And look at that. I didn't even expect to go over any Tesla specific news, but FSD V12 3.4 is now rolling out to customers. This is the first update to FSD that we are getting since FSD changed from beta to supervised. So let me know what you think about this information down below in the comments section. Do you think a larger decline is coming for markets? Do you think markets are well prepared for that? What do you think is going to happen with Tesla? Let me know your thoughts down below in the comment section. Tomorrow is going to be another big day, and I'm expecting if PPI comes in hot, you could see another 1% down day for the NASDAQ. If it comes in better than expected, maybe that's some good news. But, I mean, I don't think that's the end-all, be-all. Markets are just going to rip higher from there. I also think the Middle East situation could, to some degree, be a black swan event if, Iran did attack Israel, and that creates a larger conflict. It definitely would be for oil. Nonetheless, thank you for watching. Hit the like button, subscribe to the channel if you made it to the end of this video. You guys have a fantastic rest of your day, and I will see you in the next one.